Hello everyone, welcome once again. In this video, I'll be talking about different types of loans and how to calculate rates of return on a loan. First of all, the loans can be of various types. For example, business loans, consumer loans, housing loan, and so on. And business loans or other types of loans as well typically can be secured or even unsecured. So I will be discussing some major points in relation to them. First of all, a business loan, can be short-term for a period of few days to few weeks, or also for long-term, for example, 10 years or more. Traditionally, short-term business loans are usually provided for the financing working capital, and long-term loan is provided to invest in real estate, for example, invest in capital assets, for example, real estate or the machineries, equipments. And large business loans typically nowadays are syndicated. A syndicated loan is provided by a group of financial institutions as opposed to a single lender. A syndicated loan is structured by the lead financial institution, which is known as agent, and the borrower. Once the terms of the loan, for example, interest rate, fees, loan covenants are set, the pieces of loans are sold to other financial institutions. This means that investors can buy loans from financial institutions involved in the original lending process. So as I was saying, that business loan can be secured or unsecured. So a secured loan means when a loan is backed by a claim on certain assets, which is known as collateral of the borrower if default occurs. And unsecured loan, on the other hand, is a loan that only has a general claim to the assets of the borrower if default occurs. Okay. And loans sometimes can be either on a spot basis or under commitment. Now, spot loans is made by financial institution, and the borrower uses or withdraws the entire loan amount immediately. On the other hand, in a loan commitment, this is known as line of credit, the lender makes an amount of credit available to the borrower, let's say $10 million, and the borrower has the option to draw any amount up to $10 million in any time over the commitment period. Now, it can have a fixed interest rate, or it can have a variable or a floating interest rate. In the case of fixed interest rate loan commitment, the interest rate to be paid or any drawdown is established when the loan commitment contract originates. In a variable rate or in a floating rate, on the other hand, the borrower pays the loan rate in force when the loan is actual drawn down. Now, one last point about this business loan is business loans are declining in importance in bank loan portfolios. The major reason for this has been the rise in non-bank loan substitute, for example, corporate bonds, and to a lesser extent, commercial paper. So commercial paper and corporate bonds both are securities companies issued to raise funds. Commercial paper is used to raise short-term financing. So it's an unsecured short-term debt instrument. And bond, on the other hand, is issued by companies to raise long-term funds. Okay, so nowadays, the companies, when they need funds, they more rely on issuing corporate bonds or commercial papers to raise funds rather than borrowing money from bank. The next major type of loan is real estate loan or housing loan. Housing loan plays an important role in the Australian banking and lending market. At March 2014, housing loan represented about 53% of all bank lending. These loans are typically a simple principal and interest or reducible loans made to individuals and families for the purchase of family home. These mortgage the products typically require that interest and principal be paid back over some substantial loan periods, for example, 25 years or so. The next type of loan that we are going to discuss is consumer or individual loan. Many financial institutions provide consumer loans. For example, banks, finance companies, retailers, the banks, building subsidiaries, credit unions, they offer the personal loans. In addition, the same financial institution can provide consumer loan financing through credit cards, for example, Visa, MasterCard, or proprietary cards. Credit cards play an important role in funding household expenditure and represented 40% of the personal lending by banks in 2011. The debt provided by credit cards is called revolving debt. It's very similar to loan commitment that we just discussed a few moments back. With a revolving loan, the borrower has a credit line on which to draw as well as to repay up to some maximum over the life of the credit contract. The other large class of loans is the non-revolving personal loan, which include new and used line of credit, car loans, fixed-term consumer loans, such as 24 months loans. In recent years, banks have normally faced higher default rates on their credit card outstanding than they have for their personal loans. Rates are also significantly higher for those loans. Such relatively high default rates again point to the importance of risk evaluation prior to credit decision. Now, how do we calculate the rate of return on a loan? You understand that an important element in the credit management process on the decision to make a loan has been made is its pricing. This includes adjustment for the perceived credit risk or default risk of the borrower, as well as any fees or collateral backing the loan. So the total return earned by a bank on a loan depends on the interest rate, fees, credit risk premium, the premium that is charged for the credit worthiness of the borrower, collateral, and non-price terms, for example, compensating balance. We will discuss this shortly. So loan rate will basically equal to base lending rate. Base lending rate, maybe prime rate, that's the lowest rate charged to the most credit-worthy borrower, and then credit risk premium. Credit risk premium is the additional return charge for the credit risk associated with a borrower. Now, how do we calculate contractually promised return on a loan? Contractually promised return means when a contract is originated between the borrower and lender, according to this contract, what is the promised loan return to the financial institutions. So there are direct and indirect fees and charges on this. For example, loan origination fee. Loan origination fee is the loan processing fee. And then compensating balance requirement. Compensating balances are a percentage of loan that a borrower cannot actively use for expenditure. Instead, these balances must be kept on deposit at the financial institution. For example, let's say you are borrowing $100 with a 10% compensating balance. It means that although you are borrowing $100, you actually can withdraw $90, and the remaining $10 has to be kept with the bank as deposit. So that's compensating balance. This requirement, this compensating balance requirement raises the effective cost of loans for the borrower, since the less than the full amount can actually be used by the borrower. You can remember, you need to understand that this $10 that is deposited with the bank, you can earn interest rate on the deposit. However, the interest rate on this deposit definitely will typically be less than the interest you pay to the loan. That's why that's an additional return generated for the bank. And last of all is reserve requirement. Reserve requirement imposed by the central bank. So when a financial institution has a deposit and there is a reserve requirement, then a portion of the deposit has to be kept with the central bank. For example, when a bank receives a deposit of $10 and there is a reserve requirement of 10%, then $1 of this $10 deposit has to be kept with the bank as reserve. So effectively, the bank will have $9 to reinvest and to earn return on the deposited amount. So gross return per dollar lent can be calculated as 1 plus K, that's the gross return. So 1 plus F, that's the loan origination fee, plus base rate that we have seen in the last slide, and this is the premium that we also have seen, credit risk premium that we have seen, and 1 minus B is the compensating balance into 1 minus reserve requirement. Now, one point you need to understand that the formula that we have seen here, this formula essentially calculates the contractually promised rate of return. Now, this contractually promised return on the loan, which is, 1 plus K in the last equation, that the borrower and lender actually contractually agreed on, includes both the loan interest and non-interest features such as fees. The promised return on the loan, however, may well differ from the expected or indeed actual return on the loan because of the credit risk or default risk. So default risk is the risk that borrower is unable or willing to fulfill the terms promised as under the loan contract. The default risk is usually present to some degrees in all loans. That thus, at the time the loan is made, the expected return, look at this equation, the expected return is P into 1 plus K. So P is the probability of default and 1 plus K is the promised return that we have seen in the last slide. Now, if this P equals to 1, this is probability of loan payment, repayment. So if this P equals to 1, that means there is a 100% probability that loan will be repaid, then expected return and promised return will be same. However, when the default risk exists and that is compensated by risk premium, that P must be less than 1. So as P less than 1, your expected return and your promised return will not be the same. And this diagram shows the premiums that reflects the default risk. So these are the periods of recession. You can see these are the periods of recession. And these recessionary periods, you can see the default high yield bond rates. Okay, high yield bond rates, and you can see that as the recession periods, the bond rates actually increase, which reflects the default risk. So higher the default risk was, higher the bond yield rates were. Now, retail versus household credit decisions, because of their small dollar size in the context of an financial institution's investment portfolio and the higher cost of collecting information on household borrowers, most loan decisions made at the retail level tend to be binary decision. Binary decision means either accept or reject. All borrowers who are accepted are often charged the same rate of interest. By implication, is the same credit risk premium. For example, a wealthy individual borrowing from a credit union to finance the purchase of a Porsche is likely to be charged the same car loan rate as a less wealthy individual borrowing from the credit union to finance the purchase of a Hyundai. In the terminology of finance, retail consumers are more likely to be sorted or rationed by loan quantity restriction than by price or interest rate differences. That is, at the retail level, financial institution controls its credit risk by credit rationing rather than by using a range of interest rates or prices. It means that high credit worthy borrower will get a large amount of loan and a low credit worthy borrower will get a lower amount of loan, although maybe the same rate. So the credit risk is actually addressed by the amount of loan provided rather than the interest rate. In contrast to retail consumers, at the wholesale level, for example, for the large business, financial institutions use both interest rates and credit quantity to control credit risk. Thus, when financial institutions quote a prime or other base lending rate to business borrowers, lower risk borrowers may be charged a lending rate below or close to the prime lending rate. High risk borrowers are charged a markup on the prime rate or a default risk premium to compensate the financial institution for additional credit risk involved. So that's the end of our discussion on different types of loan and rate of return on the loan. In the next video, we will be discussing different risk models, credit risk models. Thank you very much.